Hi, glad you joined me today. Today I'd like to talk about the trade-off that determines whether a company should start paying dividends, and if so, how much. And once it starts paying dividends, whether it should increase those dividends. I think the simplest way to summarize whether a company should return cash to its stockholders is to think in terms of the cash coming into the company and the investment opportunities it faces. Very succinctly, here's what I would think. If you have lots of cash coming into the company from your operations and you don't have very much in terms of investment opportunities, you should be figuring out a way to return more cash to your stockholders. If in contrast, you have very little or low cash coming in from your operations and lots of investment opportunities, you shouldn't be thinking about returning cash in any form. Perhaps the simplest way to summarize this is to think in terms of where your company is in the life cycle. If your company is a young growth company, a startup, I would think that it's not a very good candidate for returning any cash to its stockholders, whether in the form of dividends or stock buybacks. And here's why. When you're a young growth company, you're either losing money, or even if you're making money, everything you're making is going back into the business and more because you're trying to grow. In fact, even though your income might be positive, your cash flows are going to be negative, and the last thing you want to do is make them even more negative by paying dividends. As you mature, though, as a company, here's what's going to happen. Your growth will continue, your margins are going to start improving, your income is going to go up. Your investment opportunities, even if they're as good as they used to be, are not going to suck up as much of your cash as they used to. At some point in time, you hit a tipping point. What that tipping point is that your cash flows start to become positive. Cash flows are positive in what sense? After your reinvestment needs, you still have cash left over. Initially, my guess is you're going to fight that because you want to stay a growth company, but that's not going to come back. You're going to see your cash balance start to accumulate, and at some point in time, you're going to come to the realization that you have to return cash to your investors. That's when dividend policy kicks in. There are some companies that put this off for a while. Their cash balances get really big, but eventually that cash will get returned. As you become a mature company, your capacity to pay dividends continues to increase. And then you get to that last stage in the life cycle where you're in decline and dividend policy kicks into steroids. Basically what you're trying to do is give back more cash than you're getting in because you're trying to make your company smaller because your investment opportunities have dried up. So one way to think about how much a company should pay in dividends is to think about where it is in the life cycle. So here's what I'm going to do. I'm going to take a company that most of you are familiar with, Intel. One of the great growth stocks of the last century, right? A stock that essentially powered the personal computer revolution by providing the chips that let computers run. In the 70s and the 80s, Intel was one of the great growth companies, and it did not pay dividends. As it became bigger, though, it found that even though it still had growth by the end of the 80s, early 90s, that it did not have enough investment opportunities to keep that growth funded with internal investments. In other words, it had more cash coming in than it had in terms of investment opportunities. Intel, incidentally, started paying a dividend in 92, a very small dividend, but it was an admission at that point in time that they were in fact starting to become a mature company. Now, the late 90s brought back growth to Intel with the dot-com boom, but in this century, starting 2000, 2001, 2002, Intel seems to have become a mature company. Mature company in what sense? Revenue growth is now in the single digits. Margins have leveled off and have started declining. Intel is at that stage in the life cycle when it has to start thinking about returning cash. What I'd like to talk about at this stage in the process, though, is whether it should return the cash in the form of old-fashioned dividends. Old-fashioned dividends are, of course, dividends you initiate and you continue to pay year after year after year. Those sticky dividends we tend to talk about. So to make a judgment on whether Intel is a good candidate for paying big dividends because it has big cash flows, here's what I'm going to do. I'm going to look at the 3 reasons companies give for starting to pay dividends and to increase them, and I'm going to look to see whether Intel is a good candidate based on any of those 3 stories. The first is a clientele story, which is if your investors, the investors in your company, like dividends, you should pay them as much as you can in dividends. So the question is, are Intel stockholders the kinds of investors who would demand large dividends, who would like those large dividends, and pay a premium for getting those large dividends? The second is a signaling story. What's a signaling story? Use dividends as a company to let the market know that you have predictable cash flows or predictable earnings. What you're trying to do here is you're using dividends to separate yourself from the pack, to send information to the market about your future investment opportunities. Though you can tell a negative story about increasing dividends, the story that's usually told in finance is that when companies pay big dividends, it must mean that their earnings and cash flows in the future are larger and more predictable, and therefore companies should reward them with a higher stock price. We're going to look to see whether Intel is a good candidate for a signaling story. And the third is not a very noble reason, but you could use dividends to transfer wealth from lenders to the company, bondholders and banks, to stockholders. Again, we'll stop and ask the question, is Intel a good candidate on that basis? Let's start with the clientele effect. The best way to assess whether there's a clientele effect is to look at who the stockholders in your company are. So I printed off the top 17 stockholders, actually the top 22 stockholders in Intel. And if you take a look at that list, you very quickly recognize a pattern. Almost every single name on the list is a large institutional investor. Intel is a company held predominantly by institutional investors. There are no activists, there are no individual investors on that list. That already tells you that this is not the kind of company where there's going to be a huge amount of pressure from below to pay big dividends. It's not a company with older and poorer investors. It's a company predominantly institutionally held. In fact, you can back that up by looking at the percentage of stock held by institutions and who's holding them. And here again, you find that 68% of Intel stock is held by institutions. That's pretty high. So again, it reinforces the point about it being institutional. Incidentally, this table also gives you a geographic breakdown. And here again, that might help you decide whether you're going to get pressure from below, because US stockholders tend not to put as much pressure to pay dividends as British stockholders might. But 83% of Intel stock is held by US investors. Overall, looking at the breakdown of Intel's holdings, it doesn't strike me as a company that's going to face an incredible amount of pressure from below to pay more in dividends, and paying more in dividends is not going to translate into a higher price for its shares. Next, I looked at whether Intel is a good candidate for using dividends as a signal. Think of what you're trying to do. You're trying to send information to the market, right? And you do it because the market doesn't know enough about you. I don't think that should be a problem with Intel. There are 51 analysts who track Intel. I mean, this is all they do every day, is track Intel and a few other companies. There are plenty of forums for Intel to get information out. It's a widely followed, large market cap stock with lots of analysts. I don't see how dividends are necessary as a signal. It seems like an expensive way of sending information out to the market. I'm not saying dividends won't work, but I don't think they'll provide much of an impact, because much of that news can be transmitted in other ways. And finally, if you look at dividends as a way of transferring wealth, Intel's debt ratio is about 7 to 8%. It does not have enough debt for wealth transfer to be a significant factor. Overall, when I look at Intel's cash flows, I think that the drop-off in growth and the movement in the life cycle towards being a mature company reinforces the point that Intel should return more cash to its stockholders. I think that cannot be contested. I think you can argue that that cash should not be predominantly in the form of dividends for all the reasons I've listed. None of the good reasons apply for paying dividends. And if on top of that you add the fact that Intel remains a technology company, that even as a mature company, its earnings and cash flows are going to be extremely volatile, I think if I was summarizing what I would expect to see on Intel's cash flow return, is that they're returning more cash flows than they have historically, because their growth has dropped off and they moved towards a mature phase of the life cycle, that most of the cash flows should take the form of buybacks rather than dividends, because none of the forces that would push it to becoming a large dividend paying stock are in place. So let's see what Intel's actually done. This is actually a summary of the last 10 years. And over the last 10 years, Intel collectively over the decade has had $135 billion in net income. It's paid out only about 25% of that net income as dividends. That doesn't sound like much, but that's a little misleading, because the collective dividends paid out, $34 billion, is only about 36% of the total cash return. Over the last decade, if you look at Intel's buybacks, they amount to almost $62 billion. That's about 64% of all the cash return was in the form of buybacks. And if you look at the two line items, you can see why. Dividends tend to follow this nice smooth path. In fact, Intel's never cut its dividends over the last decade, even though 2008 is there. And you've had a couple of really bad years in terms of income. Intel's not cut dividends. But Intel's buybacks are much more flexible. That's the biggest reason why buybacks make more sense for a company like Intel. It can pay out a lot of cash in years in which it has a lot of cash available, and can cut back like it did in 2009 and 2010 when it feels it needs to accumulate cash. And in fact, in the next session, which is a companion session, I will look to see what Intel could have potentially paid out in dividends, because comparing what was returned to net income is not a very good indication, because net income is not cash flow. But for the moment, this kind of summarizes the trade-off in dividends. So when you take a look at your company, look at the big picture. Where does it fit in the life cycle? What kind of company is it? How are its earnings? And what kind of investors does it have? Does it need to use dividends as a signal? And make your best judgment on what you would do with this company. Thank you for listening.